Hi, I'm Mike Pacito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures Strategy ETF, ticker DBMF. This is our December/year-end update, which we're calling Simpler Worked Better in 2024. And before I hand it over to Andrew, just a quick factoid here about the managed futures space that may be of interest to our audience. So while the average expense ratio for the Morningstar systematic trend category is 1.88%, the approximate average weighted cost for constituents comprising the SocGen CTA index is approximately 1.3% plus over 13% in incentive fees, and that does not include trading costs. This plays right into one of the key advantages of DBMF and catalysts for its historical outperformance: low fees with low trading costs. So with that, Andrew, let's get to the update. Over to you.
Thank you, Mike. So we finished 2024 up a little more than 7%, about 500 basis points ahead of the SocGen CTA index, here and after the hedge fund index, and 600 basis points ahead of the Morningstar US Trend Systematic category, here and after the Morningstar category. So a big win from a replication perspective. And the short answer, as Mike said, is that simple worked better in 2024, and I'll elaborate on this in a little bit in a few slides. Now, on the macro front, the Trump trade is back in full swing, but with a twist. The Trump trade from earlier this year was a return of economic optimism, animal spirits even. CTAs picked up on this, went long equities in the dollar, yet were cautious about inflation. Then CTAs and plenty of other smart money investors got whipsawed in the late summer and early fall as sentiment flip-flopped. Now CTAs are back in similar trades, and as we'll see in several slides, but with a constructive but more cautious view on equities, nervousness about a resurgence of inflation, and decidedly negative view on Europe via the euro. Next slide, please. Now, here's a slide that's very important to anyone who's in the business of building model portfolios. As some of you know, SocGen has taken our replication engine and built an index around it. Now, I believe this index, not the hedge fund index we seek to replicate, is actually the more appropriate index for the wealth management space. After all, why build capital markets assumptions with an index of hedge funds when you cannot invest in those hedge funds? So over time, we expect allocators to use this new index to build capital markets assumptions, evaluate mutual fund and ETF products, and as a benchmark for the allocation in client portfolios, in client reporting. Now, the data is currently available on Bloomberg, and please let us know which other analytical platforms or database it should be in so you can use it in your analysis, and we'll get that message over to SocGen. Now, this slide shows the year-to-date performance of DBMF versus the hedge fund index and the Morningstar category. Now, there's a reason I've been calling it the year of the whipsaw. Everything was working through mid-year. And then the back half of the year was characterized by sharp, spastic shifts in market sentiment. So here's how I look at it. Now, CTAs analyze prices because those price moves shine a light on changes in A, information, and B, sentiment. Now, I care a lot more about the first one. So CTAs pick up signs of inflation in 2021 and are positioned to generate a decade of alpha in 2022. Sentiment is more erratic, less stable. Sometimes it hurts, like when people panic and markets whipsaw, and other times it helps because it's pushing a trade that's been working and pushes it farther. In 2024, I think CTAs nailed the big shift in information, which was the return of Trump and everything that implied. The whipsaws in sentiment, panic at a few bad economic data points, overreacting to Powell's latest utterance, etc. Those caused oscillations in markets that meant most CTAs, including our replication, seemed wrong-footed in the back half of the year. Now, without those oscillations, it's likely may have been a historically good year for the strategy, but it is what it is. Now, quickly on tracking relative to hedge funds, you can see that for several months starting in late spring, we held our gains while the hedge funds got hit. As we've discussed, this was a period when complexity hurt. More esoteric, non-core futures were getting whipsawed. Shorter-term models got caught off sides, etc. So by the end of the third quarter, we were massively ahead. Now, in the fourth quarter, those non-core markets started to work again, and the hedge funds got caught up, and the hedge funds caught up a bit. Now, this is all within expectations, considering that replication is an approximation, obviously not an exact copy of what managed futures hedge funds do. Next slide, please. To move to inception to date performance, we now have more than 5.5 years of performance as an ETF. Since launching DBMF, we've handily outperformed the SocGen CTA index, and since hedge funds outperformed the mutual fund ETF peer group, doubled the performance in the Morningstar category. As you may recall, we spent a lot of 2023 testing our models to make sure they were still working as expected, and concluded that our underperformance was attributable not to an issue with the model, but bad luck, the equivalent of flipping tails 3 or 4 times in a row. So we made the decision not to change anything, and this proved right in 2024. Now we can all look forward to an exciting 2025. Next slide, please. So here's a slide on volatility adjusted positioning. The red dots are from the end of September, and the green bars are from the end of December. By the end of the third quarter, if you recall, we had cut back the strong dollar rising rates bet that had contributed to gains earlier in the year, but it maintained long exposure to equities, which clearly had been trending up. With the revival of the Trump trade, renewed concerns about inflation and runaway budget deficits and shakier equity markets, and a mess in Europe, the three big trades today are to be long the US dollar against the euro, a bet on a steeper yield curve, and continued gains in US equity markets. Now, while it doesn't drive how we build a portfolio, I do like that positioning heading into the new year. And here's contribution by factor. And now note that these figures are futures returns only and do not include cash returns. In any event, the story last year was very clear. Long gold worked. Currencies really shorting the yen until the yen apocalypse in July and August, and then deftly flipping to a short in the euro before the euro started to decline. And long equities were the big drivers of performance. The treasury markets were what a friend of mine called a whipsaw hell. The oscillations in sentiment were timed almost perfectly to cause reversals just after CTAs had built a directional view. In a sense, it's analogous to equities in 2022. CTAs generally got the direction right, i.e. down, but all the reversals along the way was the trading equivalent of death by 1,000 cuts. Like in 2022, but a bit less so, 3 of the 4 asset classes made money. Now that's a great outcome in my eyes. And with that, I'll pass the baton back to Mike.
Thanks, Andrew. So let's wrap here with long-term performance comparisons. Closing out 2024 as we did resulted in DBMF posting a 7.32% annualized return since its inception, ahead of the SocGen CTA index by over 205 basis points annualized, and ahead of the Morningstar systematic trend average by over 375 basis points annualized. Outperformance against the AG, the traditional diversifier for the standard 60/40 portfolio, and primary benchmark by prospectus for DBMF, inclusive of dividends for both it and DBMF, is 670 basis points annualized. This leads us to our last slide, which, if you're allocating to alternatives, is a must-see, essentially showcasing DBMF and managed futures versus all other alternatives categories in the Morningstar universe as the lowest correlation, highest alpha generating strategy within. So if you're allocating to alternatives, DBMF certainly deserves serious consideration for inclusion in that allocation. Okay, so thanks as always to our clients and to our prospective clients for your confidence and interest in DBMF. If you have more questions about the strategy, would like further information or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com.